Hello and thanks for joining us at xm.com for this weekly Outlook video. I'm Maria Pachardis and joining me is investment analyst Marios Hadjikyriakos. We'll be reviewing the week ahead. So Marios, last week GDP flash estimates for Germany for Q2 indicated that Europe's largest economy may be headed for a technical recession. What economic data will be released next week in the Eurozone and how do you think it will affect the euro?
Let's start with Germany. As you correctly pointed out, we saw some very disappointing data last week. We saw the economy contract in the second quarter, and in a worrying signal, the Bundesbank, Germany's central bank, came out a few days later and forecasted another negative quarter in Q3, which is the definition of a technical recession. So it looks like Europe in general is weakening as a result not only of Brexit uncertainties, but due to the trade war taking a heavy toll on German exports in particular. So all eyes will be on next week's data to see just how weak the situation, just how soft the German economy perhaps is. So we'll start on Monday with the IFO business survey, which will be followed on Tuesday by the final estimate of GDP for the second quarter. And we're also going to get inflation data both from Germany and for the Eurozone as a whole. Now, as far as monetary policy is concerned, the European Central Bank is almost certain to deliver a large stimulus package in September. So the incoming data between now and that meeting will probably determine how big of a stimulus package that will be. Now, as far as the euro is concerned, the outlook is not particularly bright. We have the possibility of the bloc entering a recession before long, and even if it avoids a recession, growth will be, in most of the important economies, growth will be almost flat this year. So we also have the external risks, Brexit, the possibility of a chaotic Brexit in October, and also the trade war escalating even further and impacting German exports perhaps even more. So I would say the outlook for the euro is pretty dark right now, especially against safe haven currencies like the Japanese yen and the Swiss franc that may benefit from another escalation in trade, for example.
Right. Now, the GC summit in France will take place this weekend. And while these events may grab some media headlines, they don't usually move markets. Do you think this time will be any different?
Well, we very rarely see G7 or G20 meetings impact the markets, but this time may be a little different. So last year we saw the US president essentially throw some jabs at the Canadian Prime Minister, threatening Canada with tariffs as he was trying to pressure him into renegotiating NAFTA. So last year was quite interesting. It may not be as eventful this year, but if there is any market action, I would suspect it will be towards a weaker risk sentiment. So the risk is that Trump escalates trade tensions even further. He has threatened, this time though, with Europe, not Canada. He has threatened Brussels with car tariffs multiple times in recent months, and I suspect he may use the opportunity of meeting the European leaders in person to double down on those threats. So if we were to see any market reaction, I believe it could be towards weaker stocks and stronger safe havens.
I see. Now, turning to the US, we have several data releases on the agenda, starting with durable goods orders on Monday, and the Fed's favorite inflation measure, the core PCE price index, out on Friday. Will these be game changers for the dollar?
I very much doubt that. The Fed is almost certain to cut rates in September, and it's not because the domestic economy or the domestic data are particularly worrisome. The Fed is essentially trying to shield the US economy or to safeguard the economy from the fallout emanating from trade tensions and a slowing global economy. So in other words, the Fed is trying to make sure that the US does not import a recession from the rest of the world. Now, in that sense, I believe that the bigger determinant for how the Fed acts and therefore for how the dollar moves over the coming weeks will be what happens with trade. As things stand right now, the US is set to impose new tariffs on China on September the 1st. If that goes ahead, we could see some more expectations for more aggressive Fed easing in general over the coming months, which could therefore hurt the dollar a little bit. But here's the caveat. Any dollar weakness may only show up against safe haven currencies. So the dollar might lose against the yen, against the Swiss franc, but not against risk-sensitive or trade-sensitive currencies like the Australian dollar, the New Zealand dollar, or even the euro for that matter, because escalating trade tensions will likely hurt those economies even more than the US. So we could see the dollar lose out if we see trade tensions escalate again, but perhaps only against the safe havens.
Marios, thanks so much for joining me, and thanks for watching at xm.com.